All righty, good morning, traders. This is Blake. You are listening to the Face Show. No, I'm not Dale. Dale is without power today, and he's which sucks because it's actually pretty cold. I mean, I know his climate is not too far away from where I live, and so as far as what he deals with. So I told him last night he's got to bundle up and keep warm. So it's he's probably pretty chilly. Anyway, Dale will be unfortunately out today, and I'm going to also host Patrick Bad Charts interview after the jobs report. But we got to get through the jobs report. So TJIF, everybody. Hey, before I even get started, I know there's a lot of you guys that are just listening in and just getting tuned in. You'll notice that we have I put up the trader funding program page. This is for the very first time as of yesterday. We are now offering instant funding. So basically, you have access from a $5,000 trading account all the way up to a $100,000 trading account. With that access, you can see what the plans cost. So, for example, you want a $100,000 trading account, you put up $5,000, and that's your risk. You have 5%, max drawdown, and you have a max 5% daily drawdown. And you can keep 80% of your gains, or you can add on. There's an add-on at the checkout where you can keep up to 90%. So this is a very, very brand new plan as of yesterday. Now, this is only available to non-US traders, so I need to make that clear. You cannot be in the United States and qualify for this plan. We still have the two-step programs, or excuse me, the one-step program, but this is instant funding. You go directly into trading a live account. So, yeah, it's a really, really awesome, awesome thing for many traders out there. I mean, you want to leverage up your money and you want to take advantage of some big moves. You just have to be able to control your risk, like any trader should. So yeah, if you're doing like a martingale type of strategy, this is not for you, and you shouldn't be trading that way anyway. So anyway, I just want to mention that that is as of today. It's a really, really, like I said, it's a great opportunity for you. The the trader funding program has been a successful venture for so many traders. And so this is just another, evolution in the funding space to give you guys access to larger amounts of capital. All right, now we are going to get into everything that's happened overnight and what we're expecting with the jobs report today. And I'm going to kick it off with I see that Stelios is here. We got Stelios, Ryan, and Steve, and Dale's not here today, but I think that's it. We might have a couple more people jump on in, but let's start off with Marco asks, is the platform the same? Yes, for the non-US traders, and you can select which platform you want to go to. All you have to do is go click on the links. So yeah, it's called
There is a comprehensive FAQ as well. Sorry to interrupt.
no, go
Uh,
please go ahead.
where
Yeah.
you can, any question you have basically gets answered there. But if you still have questions, there's the intercom button at the bottom right of the page. You can use that, and one of our staff is going to be there to help.
Mhm. And that's called the platform 4, Marco, just so you know. Um,
Yes.
all right, Stelios. Good to hear your
Blake,
voice, buddy. What's going on?
hello.
Hello.
All good. Nice weather here, I have to say. So, all good and waiting for these amazing numbers today. Let's not forget these are the last payroll numbers that the BLS is going to report before Trump takes power. So these are the last Biden numbers, and I know I've been called the conspiracy theorist before, but I'm sure they're going to try and make them look better, as good as they can before everything just collapses after Trump takes over. But all jokes aside, we are expecting what is the 164K, 227 was the last number. The average has been around 200-ish. So slight deterioration expected. Let's see. We do have also unemployment and average hourly earnings, which are always important, and the details of the employment of the jobs data is also important. So quite a few numbers to digest and see how that starts the year.
And I know if you were listening to the Flow show today with Ryan, K-Man is still out. He thought he could make it back today, but he's got a lot of admin stuff, so he'll be back in the saddle as of Monday. But listening to Ryan's Flow show this morning, he's really focused on the unemployment rate. And Ryan, I'm sure you want to chime in here with your comments with the unemployment rate. But what are you looking at, and why does it matter today?
Yeah, well, as always happens, or sometimes happens with these jobs numbers, that the market needs to look at different things because the Fed is different. Is looking at different things. One time it could be wages for the inflationary impact. Another time it could be unemployment. So we're in that phase where we're looking at unemployment. So I think that's going to be, that's going to be the main driver. The unemployment number is going to be the main driver today. Obviously, you've got to match that up with the participation rate because that participation rate can move the unemployment rate as well. So it makes it sort of a lesser move. But yeah, the headline's always going to be important. For the first glance, we're expecting 164,000. Anywhere, I think, between 100 and 200, and the market won't really pay much attention. And then there will be real focus on that unemployment rate. If that goes up 4.3, 4.4, then that's going to bring into question the market's expectations for the Fed going on pause over the next few months. On the other side, if it's decent, if it drops to 4.14%, and it's not a big shift because of the participation rate, then we're going to see yields continue to be supportive and thus the dollar.
Yeah, and let's talk a little bit about yields really quick, and I'd love to hear what Stelios and also Steve have to say about this as well. The Fed obviously they cut rates by 50 basis points, and then we've seen is higher yields since then. I mean, whether you're talking about the 30-year or the 10-year, ever since the Fed made the move. I mean, look at this rise that we've seen in yields. So how do you explain that to traders? And has this taken this has kind of put some more pressure on the Fed, I would think, that they'd have to it's actually working against them, and they would be more inclined to cut further just based on the rise that they've seen in notes and bonds and yields
Well,
rather.
this is no different to what we had all through the hike cycle, all through inflation. The market trades expectations. The Fed has been cutting. It wanted to cut. It has been cutting, and now it's come to a pause. And this is the market readjusting to that. So my view is, how much further can it go? We've had this reprice, however you want to call it. What's it going to take to get the Fed more hawkish? That means go into hikes from a pause. And no Fed member is touting that. Even the last couple of Fed members, Bowman, I think, Schmid or whoever, Collins, saying we're still in a cut cycle. Okay, so my question is, how much further can these yields go before the market goes, hang on a minute, this is too much to pass up on. We're going to start buying some bonds and locking in those higher yields. So even a good number today, I think we might get a little poke up in yields again, and maybe a poke up in something like dollar yen. But how long that will last, I'm not so sure about.
Okay. So, Stelios, what do you have to say about this rise that we've seen, this rise in yield since the Fed has cut, when they cut 50?
Well, I think the market often overreacts. And remember, when they looked like they were going to start cutting, we were pricing, what was it, 6 cuts or 7 cuts at some point for the year. And they delivered less. And I think now the market's overreacting the other way. I mean, we cannot have 2-year yields which are flat or actually slightly higher than overnight. It doesn't make any sense to me given the current state of the economy and the way I think it's going to go. So my answer to your question is I think the market's gone and overreacted again, and I think we're going to be moving the other way, back down pricing cuts, probably overreact in that direction again, and then we keep going. So I think that, like you asked, what's the catalyst? What will it take for yields to go higher? It will be a pricing of hikes, which I absolutely do not see at the moment. I really don't see that. So I think
All right.
we are at extremes now. We are at an extreme, and I really think we are at or very close to a high in yields, unless something major changes in the U.S. economy.
Yeah, speaking of extremes
I
here, we're in this is in the Forex Analytics chat room. You see in DSI, the bonds and notes both are pretty extreme as far as sentiment goes. And it doesn't get too much more extreme. I mean, we can go into the single digits here, but it's been pretty extreme for the last actually several weeks. So we'll see if we get that today. I mean, in the chat room here, Omar just posted that prediction markets are expecting 183,000 jobs. You could probably say that's probably close to the whisper number. Everybody's coming into this jobs number same attitude as Stelios. Hey, this is the last number from the Biden administration. It's going to be a good number. Can't be a bad number. The a miss, I think, would be more of the unexpected at this point in time. But I don't want to wrap up this yield conversation just yet because I saw Steve unmuted himself. So that means Steve has something to say. Steve, good morning.
Good morning, mate. First of all, I agree in a lot of things that Stelios said, although I disagree with one. I believe that it's totally normal for yields to be moving higher. That's what they should be doing. I agree 100% with him, though, that that's not going to go on for much longer. Not because it shouldn't, but simply because the Fed is not going to allow for that to happen, as he said. So I don't like the move higher in yields for one reason and one reason only. And it is because I know that they're not going to tolerate it for much longer, which means they're going to be doing something. Now, what that something is going to be, it's not 100% a slam dunk thing to say that they will cut rates even more aggressively, right? Because inflation is still much, much higher than expectations. What they might actually do, though, is revert to using other monetary policy tools after oral intervention, which, of course, as always, is going to be, the first step. Like, for example, completely stopping quantitative tightening, perhaps even reverting to quantitative easing if needed.
Yeah, I mean, what would stopping QT look like?
They stop selling bonds.
They stop selling bonds.
Yeah, well, no, they stop selling bonds, but more importantly, it's what they're reinvesting and buying again, right?
Yeah,
So
and of course the exact opposite alternative is going back to being buyers again of bonds instead of sellers, right? Because they went from buying them for years and years on to selling them, and they can just revert to buying them back. Of course, that will have side effects having to do with the size of their balance sheet.
And this has been the net result over the last couple of years as they become net sellers. So,
but it is what it is.
Yeah. All right. Well, good. Steve, thank you for your thoughts. And speaking of which, let's stick with you, Steve, really quick, because we have about 15 minutes before the data does come out. Today, you're looking at the jobs report. We've got numbers coming out, and what are you thinking, and what would be the best trade setup in your view? Because right now, I mean, the dollar's been very strong. It has euro pegged to the lows. Sterling's obviously under pressure due to the rise in 10-year gilt yields. You have the Aussie and the Kiwi that are multi-year lows. Dollar Canadian's perched up above 140. What are you thinking here? And we do have Canadian data, by the way, coming in today.
I can't obviously guess the numbers, right? Nobody can. What I can tell you with certainty, though, is that the dollar is holding within its ascending channel, and as long as that's the case, the path of least resistance is higher, right? Now, if for some reason the data actually force the dollar to break down from its ascending channel, then we're going to have a totally different situation to talk about. But until that happens, we have to keep respecting the upside for the dollar. And yes, I know that several of the FX pairs are on important supports or scraping the bottom, but that doesn't mean much. In my opinion, if you ask me what has been the biggest move already today, and the thing to focus on, regardless of what happens to the jobs data, is the breakout in crude.
You know, Steve, I
Crude was
just
testing the confluence of resistances, key confluence of resistances at 74.5 during the past 5 days. Every single day. Yeah, I have my trend line drawn a little bit different, Blake.
I just closed my pattern in play this morning from last week. So, but this is all pretty key. But it's a big move. It's a big move.
Yeah, but I think that this move is actually starting today. I think we've broken through some very, very important levels today, and I think that's the prominent move to focus on today.
Okay. All right. Well, it's definitely breaking out. So thanks for the update there. And like I said, my biggest concern right now with crude, and this is the targets I was really looking for. I pulled it just a little early because I knew we had jobs report today, but I was looking for the 161% extension here. That we're getting to right here, and then the trend line, and then we're also at a 38% retracement. So as a result of that, I was like, okay, well, it's gone pretty far today, but I still think you have to be buying dips here. So I'm with you, Steve. I mean, a range extension of a month. We had a couple of months of consolidation. I mean, that simply put should put us probably closer to 80, than anything. That's what I would be thinking. Okay, well, Steve, thanks for that update. I want to hear from Stelios really quick, and then Ryan, I'm going to come to you because I want to talk a little bit about what the BOJ said, or the sources said last night, and kind of what some ideas here as we move into ahead of the jobs report. So, Stelios, what are you thinking today as we are waiting for this jobs report, and what were you going to be looking at, and any particular pairs or any particular markets?
Yes, well, there's quite a few which are at supports or at resistance. There's quite a few markets which are at very important levels. I've been talking about yields for a while, and the 10-year US is basically only a few basis points away from its highs of 474 that we hit in April 20 of last year. So that's one which I'm looking at, and I've said this week. I think for me, one of the main themes of the 2025 is going to be lower yields. And I know that I'm a contrarian in this because everybody wants to see higher yields, apparently. So that's one trade that I think has a very nicely defined risk reward. So if you like getting long bonds, this is not a bad place to be ahead of the number. Of course, if yields break above 474, you get out of the trade, you go to the next one. But on the currency side, quite a few dollar pairs are very close to or at important levels, like the Aussie. The Aussie is about 15 pips away from the lows. There you go, and there's quite a bit of clean air below if that does get broken. And similar with the Kiwi. So quite a few of these pairs. So if you think that the number is going to be weak, then very clean entry levels here, I think, with stops up, below
the big
breakdown.
problem with these numbers tell you is that it's impossible to have any faith and trust in them.
Yeah.
And
yeah, we know that.
and somebody that isn't listening to what I'm saying frequently enough, but might be thinking like, this is a conspiracy theory or something. It's not about that. We have examples of many, many years that we're seeing numbers come in somewhat of a consistent way, week in, week out, right?
Yeah.
And then getting a yearly revision of 1 million jobs, which makes all the numbers that you got during the past year irrelevant, right?
Yeah, so I mean that means if you have a good number today, you got to take it with a grain of salt.
Yeah, in general, we're seeing these huge revisions almost on an annual basis that if you divide them by 12, you understand that the numbers that you were getting on a monthly basis were so much off that they were irrelevant.
Right. So, like I said, that's why if today's data and Ryan made a good point that if the data is good and you still see the dollar weaken today, that you got to be taking that into account. But Stelios, going back to your idea here about yes, you got the Kiwi or the Aussie at some pretty key support. Why not wait for the data to release? Because where's the Aussie going to go from here? I mean, literally, if let's say the jobs report comes in and we create 80,000 jobs, which is going to be well below, and let's say unemployment rate ticks up to 4.3%. The Aussie is going to spike up to 62.20. I mean, if you're buying it at 62.20 or 62.50, I mean, your risk is still very, very small because it's so close. So we're so close to these big key levels. Why not wait for the data to come out first before buying them?
You could do that, but you'll be missing the first 30 or 40 pips and chasing something which is going higher. Of course you could do that. Yeah,
Yeah.
of course.
Okay.
You're absolutely right.
Yeah. Okay. I mean, I'm playing devil's advocate here.
Yeah,
So
yeah.
yeah. All right. Ryan, let's talk a little bit about some of the things that you said on the Flow show, and let's start with the dollar yen. So the dollar yen took a really big spill. I say big spill. It wasn't really that big of a spill, but it took a little bit of a move. Those little articles. Article came out citing sources about rice prices and inflation. Possible adjustments. Tell us a little bit about what you were reading and the reaction there.
Hello, sorry, we just lost power here, so I had to switch to my phone.
Okay.
Sorry about that.
We'll see you in a minute.
No, it's okay. I'm here. I'm back now on my phone.
Okay.
Yeah. So you asked me why wouldn't somebody just wait for the number? I think it's just the way you choose to trade.
Okay. No, thank you, Stelios. Appreciate that. Ryan, the question I just asked you about the sources. What's your thoughts here?
It was dropped by Bloomberg, and we know their record of trying to stir things up. It wasn't indicating, it wasn't a direct sources piece that the BOJ are going to hike in January. It's that they're going to assess inflation levels and they're going to reassess their forecasts because it is a forecast meeting. But the market took that as an insinuation that hikes are potentially on the table for January. But we played this game in December when we had all these sources pieces talking about hikes, and then UADA stuck a big old pin in that and blew all those expectations up. So we've seen a bit of a move in yen, just down to some minor support around 157.60 odd. But it's gone back since. I don't think the market's going to do anything with this, but given that we've got NFP, get over that hump, maybe the market will start to switch some of its thinking back to the Bank of Japan and whether this meeting will be the one that they hike. So again, it's another reason why you might not see dollar yen taking off if we switch to Bank of Japan trading straight after.
Yeah. Okay. All right. So now, in the event that we have weaker data, maybe the dollar yen is a play because you would see lower yields, and the yen's already got a little bit of a kick in the ass from the overnight session due to this article. So maybe that might be a decent short.
Yeah, I mean, I'm with you. With the NFP, you got to trade after you know what the numbers are and what they mean, rather than before it. We've got clear levels here: 157.60, 158.40.50. Okay, we're pretty much bang in the middle. So if it's a strong number and we bust up through 158, 158.40.50, we've got to hold it. If we go up to 158.70, 80, and then 30 seconds later we're back below that number again, yeah, exactly like that, then you've got to be careful with that. So the first sort of 30 minutes are really important for watching what the price action wants to do So just be careful you don't get sucked into something that spits you out 20 minutes later.
Got it. Okay. And what other thoughts and ideas, trade ideas do you have going into the data?
Well, I'm actually still long a bit of dollar yen, playing that headline stuff with Trump the other day. So I'm long from down at 157. If I see a bust up through 158, 40, 50, then I'm going to be taking some profit and yanking my stops up. But you've got to look at this data. It's not going to be a game changer for the Fed, potentially. It's not going to be a game changer. So roll with the punches, but remember what the Fed wants to do. They still want to get rates down, even if they're going to go and pause for a few months. So again, further dollar strength. I don't know how much further that will go on the current expectations.
And remember what Trump wants to do, which is to get the dollar down and rates down as well.
Yeah, but we've got to wait. We've got to wait to hear how he's going to do that. So we're
he wants to get the dollar down, rates down, inflation down, all at the same time, while supposedly reducing the budget deficit. Right. I mean, yeah. Okay. I really want to say
he's got some pretty lofty goals here. So
he has goals that are contradicting one another. They can't all happen at the same time.
Don't forget
we do have Canadian employment. Market's looking for 25,000 jobs to be created out of Canada. Don't dismiss Canada just because the dollar Canadian's in massive breakout territory too, and that's the one other thing. I do want to say this, that with Canada, it could be a double whammy. That means we could be breaking out well above 145 on strong U.S. data, weak Canadian data. Flip side is we could get a complete opposite on a breakthrough this channel support, especially if we broke through 143 on strong Canadian data and weak U.S. data. So the dollar CAD would be in, and I think the Canadian could have actually a little bit of lift, especially knowing that Trudeau is on his way out. Just as a whole, I think one of the things that's just supportive of the dollar CAD is just the weak or the strong U.S. dollar just in general. And I just want to mention really quick as I get set up here, we're going to put up three different charts. I think waiting for the data makes sense today, and I like going on with Ryan's idea. Let's see if we get a strong piece of data. Let's see if the dollar can hang on. Let's see if yields can hang on. This is the dollar index right in the middle. You're going to have the S&P right over here to the right, and over here is going to be to the left is going to be yields. Stelios, I think you were just about ready to say something, and I started talking. So did you have something you wanted to mention before we get this data?
I didn't actually know, but I agree with the CAD. I agree with a lot of dollar pairs which are at very important levels.
Okay, and there's yields just kind of pinned right up at the highs here. Now, what you'll see here, this is the data flash. You can get that in ForexAnalytix right over here next to the calendar. You just click on there for the data flash. You can look for data, several different places. You can do it here, but this is a pop-up that we're going to just run on the side next to all of our charts. Steve, any last-minute thoughts before the data comes out?
Not really, mate. Nothing.
Okay.
That we haven't already covered.
Ryan, any thoughts here before the data comes out?
Nope. I'm all fingers poised to start typing.
All right, yeah, and just remember, we have Patrick. Matter of fact, Stelios. Well, you're on your phone, aren't you?
No, I'm on my laptop, but my phone is my hotspot. So let me find him.
Find Patrick. I believe his last name's Kareem.
Yes,
but he's bad charts, and we're going to be bringing him on.
I've got him. I'm going to promote him to panelist.
Yeah, let's see if we can find him. That would be great.
I got him.
All right, appreciate it. We'll bring Patrick on after we analyze the markets following the data. So here we go, guys. We are about
30
seconds away from data. All right, heads up, guys. This could be an explosive one today.
See, if Dale was here, he'd be singing, Blake. So
I'm not singing. I can't sing.
Use less leverage. No, I can't.
Yeah, right. All right. Market's looking for 160,000 jobs. Unemployment rate at 4.2%. Let's see if we can get a good number here.
Average hourly earnings expected 4% year on year as well. Let's go. Employment data is good in Canada.
256, 256.
256. Yeah.
256. That's good. That's good
Average
data.
hourly earnings down a bit. Unemployment down a bit as well. Participation rates unchanged.
Well,
So
so you
these
wanted
are
good
good
data, we got
numbers.
good data. That's what we got. And dollar is ripping. Now, the question is, are we going to see the dollar reverse here, or is this just going to keep the dollar just under pressure at this point?
Huge number in Canada as well, 90.9K.
Oh, wow. That is big. Oh, okay, so the
Unemployment rate
Aussie
down as
just
well.
got down to just broke through the lows through support here. Wow, that is some big news. And you know, the Aussie is actually acting fairly well. The euro looks weak, but you know, I mean, the euro hasn't taken out I was expecting the euro to trade down to 102. It hasn't. Sterling has broken into new lows. That would be expected, especially following the sterling price action this week. The dollar CAD has shown a bit of a reversal. All in all, I mean, we are seeing really, really a strong dollar move here.
Yeah, UK yields going as well.
But look at how weak stocks are. Stocks have just absolutely taken a dump too. The S&P's really come under pressure following that data. What are your thoughts here regarding stocks? I mean, you know, we had such a great news. I guess the market's looking at it saying, I wouldn't expect this to last, but the market's probably thinking, okay, well, the Fed definitely isn't cutting rates, so that's not good for the market. You have any other thoughts there?
I personally don't think the move in stocks is, if you had told me this is the number, I would have thought they would have gone more. And we're still above the previous lows, sort of kind of the recent lows of 58.05. So we need to break that first. But stocks again are not trading that badly. Of course, they are down now on the number, but
Yeah.
dips just keep getting bought. Let's see.
I mean, Nvidia is down 3%, or excuse me, 2.5% pre-market. Microsoft just dropped from being up yesterday. Let's see what Apple's doing. Apple's down 0.5%. Really, not, yeah, as you pointed out, not horrible here, but the dollar index has absolutely taken off. Good data as Stelios predicted. New highs in the dollar index. So we've taken out 109.50. Pretty bullish
I think
move.
it looks more and more likely, Blake, that the market will force the hand of the Fed to act.
Yeah, and so what's the Fed going to do here?
They're going to start by oral intervention, which I doubt will have any meaningful results, and take it from there.
All right. Well, we'll see. We'll see if that may even makes a difference at all.
Keep in mind, though, that regardless of what we're discussing, a strong dollar is a good thing, regardless of the fact that they won't acknowledge it, that they don't like it, and all that. It's a good thing to begin with because a strong dollar, especially for an economy like the US one that has huge deficits, etc., is helping significantly with taming inflation. Right?
Yeah.
And also, if you're a net importing country,
like the US is.
Yes, strong currency is good. If you're exporting,
Yes.
you want a weak currency.
Yes.
Yep.
Yeah, and
Economics 101.
just a heads up here, US dollar Norwegian krona, it's on its way higher towards the 161% extension as well, because this thing is fighting even strong crude today. So that's another thing to be keeping in mind here. All right, well, guys, Ryan, any last minute thoughts? I know you are busy typing over there, but any last minute thoughts on what you're seeing today?
Yeah, we're seeing a bit of move. Euro dollar's just gone through that prior low, so you might get a move to the big figure. Cable's getting dumped under 122 now. Yeah, it's all kicking off again. So keep an eye on those yields if these moves can be sustained.
Yeah, these are pretty massive here. So Sorry, just taking a look around here. So the euro almost reached this is a big 618 retracement. Don't forget that. We're really close to the 618, which is a long-term. I've always talked about buying at the euro at 102, and we're basically here right now. So I don't know about doing that right now, but that is truly the case. All right, Stelios, Steve, Ryan, you guys have been awesome. Thanks everybody for tuning in. We have Patrick from Bad Charts. I'm going to bring him in. Like I said, I'm stepping in for Dale today, so I'm going to spend a little bit of time with Patrick here, and want to reiterate, guys, if you haven't seen the trader funding program where you don't even have to take an assessment, you can go straight into funding. Make sure you check that out, and that is for non-US traders. US traders, we only have the one-step assessment available at this point. All right, so with that being said, Ryan, thank you. Stelios, Steve, thank you, gentlemen, very much.
Thank you,
Thank
mate.
you.
All right, and Patrick, good morning. How are you?
Good morning, sir.
Hey, welcome and happy Friday and happy jobs report day.
Yay.
Hey, yay. Hey, I know you're I've never had a chance to talk with you, but you are the bad charts guy. So that means you probably want to talk charts. Let's see what you got. Tell us a little bit about yourself, and I'm gonna go ahead and stop sharing the screen. And why don't you bring up some of the charts that you want to talk about, and let's discuss kind of your background and what your thoughts are following the jobs report here.
All right, let's do it. Well, yes, of course, it's like everything is chart defined. Like from a chart trader's world, we accept that we don't know everything, right? And even somebody who does fundamentals and analyzes individual uncharted metrics, you have to accept. It's kind of weird because this the job report has to move in this direction, the U.S. dollar, but that's because you're looking at it through the evidence that's presented to you, and you think that's what's moving it. But did you ever think that maybe there's an element that you don't know about? And how dangerous is that? Let's say whenever you go play a game, I go play poker there, and I just know some of the rules, but I don't know most of the rules or all of the rules. Isn't that like a dangerous proposition? And I see it all the time. People trading with their money, like it's they hear a tip, or they see this influencer do that, or there's this element there, and after that they start like placing bets on the markets. And it's just, for me, like the easiest thing is just take a step back. The chart is the aggregate of all known and unknown fundamentals, any metric that, to me, so I don't need to worry about individual jobs report or stuff like that, unless if I was able to chart the unemployment rate, which I do often, right? It's like I call it chart defined macroeconomics. If I'm able to chart the Fed fund rate, if I'm able to chart that, then that's more valuable information than just expecting something based on a number. It's like, look, I show you, because I was listening to you guys. I joined a little bit before there, and you're wondering, is like the markets, should we buy this dip? Well, everything also is defined by time frame, right? You guys, I saw sometimes you're on the daily, on the weekly, but not all daily defined corrections or dips are built the same, right? If you're at the beginning of a monthly defined breakout, so let's say here, guys, on my screen, what I have is the, let me zoom out. Here, wait, back. On my screen here, I have the monthly chart of the SPX, all right? Above, that blue line is the 12-month moving average, the red line, the 36-month moving average. And at the bottom pane is the distance from the 36-month moving average. So how far are we away from the 3-year moving average? And often, sometimes people say it's reversion to mean. You could, once you're stretched, a lot of the gas, the fuel that was used to explode the price off a big base and then to drive it up and away from that moving average, sometimes it runs out of steam, right? Whoever wanted to buy bought. And then people who bought lower, they're gonna want to sell, and then it just stalls the price until there's a reconnect with the moving average eventually, right? Look where we are here. Look at the SPX, how stretched it is from its 36-month moving average. It doesn't mean it's a top here, guys, by no means, but the low risk entry is when you're coiled and tight close to a moving average and breaking up away from it, then stretch. And these areas here right now, unless you have some type of melt up here where it keeps going up like we had in the 2000s, from a statistical perspective, I say I'm in the range now of FOMO, of profit taking, possible tops, possible now my daily defined corrections. If I have a correction starting on the daily chart, it has a higher probability right now of cascading on the weekly. And if the weekly, correction starts failing, then maybe this black line here, this rising trend line might fail. I might start losing momentum, right? If there's a break here with my distance from moving average failing to accelerate at the same rate, I'm in the start of a more important correction, right? And remember, all important market tops start with innocent looking corrections on the smaller time frames, but not all smaller time corrections are market tops, right? So you got to be careful. But this, when I see that, I would never enter here on this, even a shorter term correction here. You got to be extremely nimble to go along the SPX right here because you're in the fluff territory, right? And about these yields, if you don't mind me ranting a little bit more,
No, please.
this is the I got here the 2-year yield, so it's very fine there. It's the candlestick chart, and I have the Fed fund rate here overlaid on top of it. And sometimes because I heard somebody say the 2-year yield is moving upwards against the Fed fund rate. That means it's the market being smarter than the Fed, and they're probably going to stop cutting. And I said, okay, let's look at the evidence, right? Because whenever you hear any anecdotal or any one-time piece of evidence as a chart trader, you got to look at the charts and see what actually is happening. So when I overlay the two, I say, okay, they're not tracking exactly the same. So maybe I'm not looking, instead of me trying to fit a narrative in here, I'll say, maybe I'm not looking at the metric or instrument that the Fed fund rate is actually tracking. So here below, I'm back at the 2-year yields. I put the 36-month moving average on the 36-week moving average on the 2-year yield. And then, hey, look at that smoothed out curve. And look at that. If I overlay the 36-week moving average of the 2-year yield overlaid with the Fed fund rate, now I got something better, something that tracks more. So the Fed fund rate, maybe the Fed slow, maybe by the time they ingest their metrics, even if the market's like jittery and volatile on the 2-year yields and it's starting to look like it doesn't want to go down the 2-year yields and go up, the Fed looks that they track more the moving average of the 2-year yields. And look at that. For me, as long as the 2-year yield, the moving average of it, the 36-week moving average is trending downwards, not flattening, for me, the trajectory right now, the Fed's going to keep cutting and keep cutting and keep cutting until the flat line. I don't know which one's the chicken or the egg. Eventually.
So you're in the camp that they will just continue to cut.
100%. If they're cutting, and look, I have the overlay recessions right here, the green overlays. These are recessions. And I asked ChatGPT, what are the official dates of the recessions overlaid versus when they actually happen, when they announce it, right? Man, they're usually 6 months to a year and a half late in announcing it, and for the start of a recession and the end of a recession. So you gotta, if like these green overlays were added like almost when the recession was actually ended. So it's kind of weird. Like if you're waiting for the National Bureau of Statistics or whoever, of labor to tell you when the recession is, it's like it's gonna be in hindsight, right? But when I see this, a Fed fund rate cutting like that, you gotta say, my goodness. And I'll show you here. Here's an exception here in the 90s, but I'll show you why this is more of a glitch than an actual. When they start cutting like that, we're in a recession. They're coming up shortly. Maybe I think the recession is actually going to start when the SPX starts faltering, like from that top chart I showed you. But we're really, really close. And look at this one here. Here I added here's the SPX reactions, right, on these recessions. Drop. Here, except here, when you see this Fed fund rate here went up and sideways. Look at this. Here I have the unemployment rate, that blue line here. So it's additional. It's called also the weight of evidence, right? You add more evidence. The unemployment rate had peaked and was unwinding. Practically nowhere here did you have a new uptrend, right? I could have drawn a trend line. It's very difficult to see a new uptrend and unemployment rate. So even if the rates were going up here, as long as the unemployment rate is peaking and downtrending, the markets are 100% safe. So as this was unwinding, look at that. We had the dot-com bubble, which was beautiful, right? But every time the unemployment rate bottoms and moves up 25% off a bottom, recession, 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 recession here. And look at that. Look what's happening. It's trending upwards. Or like I have other charts where I show this. It's we're off 25% off a bottom here. So if you add the evidence with the Fed fund rates turning down, with the unemployment rate going up, with the yield curve, the 10 minus the 2s going up, goodness gracious. The only piece of the puzzle right now is missing is the actual SPX to drop, because that's the final piece, right? But in no
And so,
way.
I mean, yeah, and so tell me what you feel about, or how you feel about equities here. I mean, everybody's trying to call a top. Everybody thinks that the market's it's gonna come down, due to, for whatever multitude of reasons. What are
Yes.
your thoughts about the S&P?
You can't look, you can't call tops. You can't, how can I say this? You know how it is. Like people call tops, they're going to call 100 tops before they get the top, right? Only in
Right.
hindsight, we're ever going to know what the top is, right? But we can know is, as chart traders, is if we start failing. So let's say I'm going to bring up here. I'll bring up, here's the SPX. Here, look, here even is SPX priced in gold. Distance from the 36 quarter moving average here at the bottom. It's priced in gold. The SPX has already lost a rising trend line. But I'll just go the SPX because people, they don't care about gold. So here, quarterly chart stretched, but there's no breakdown, right? There's no you can't say there's any type of breakdown here. There's nothing here. So what you do is you zoom in, right, until you find a time frame where it is starting to fail. Here, there's like even this, it's still an uptrend. I'll go on the weekly. Let's move that green line. I'll put it black. Nothing against green, but let's put that line black. Still an uptrend, still above its 36-week moving average. Nothing here. So let's say on the daily, I have a feeling the daily is starting to roll over a little bit. So it's, oh my goodness, getting close. So look at that. Ah, man. So it all, like I said, it always starts on the smaller time frames, right? So if the daily is looking like that, I'm pretty sure all the other time frames under the daily have rolled over. 1, 2. This is a valid rising trend line, right? 3 points. This is the thing. Before you go in a downtrend, you go neutral. So that's a trend that's going up above an inclining 36-day moving average or whatever it is. That's an uptrend. Before it goes down, it has to go neutral. It has to start putting price points around the moving average to flatten out, right? So that makes it vulnerable. So that's what's been happening for a while now. We're below a moving average. It's not trending upwards. So now what I say is, from a statistician point of view, I say, okay, we're increasing the risk now. I can't be bullish anymore. Anybody wants to be on this time frame, of course. For me now, what I do is I draw lines in the sand. If I see what the chart is morphing into. So if I'm below that line here, and I'll put a horizontal one, probably here. So as long as I'm below 6,044, you're in a congestion area. Here's a more meaningful resistance level, support level. Man, you're no man's land right now. So you step aside. You don't buy a dip. There's no breakout here. You don't buy dips. You buy the breakout following a dip on a bounce of a support, right? Because you don't know you don't know if this is going to cascade into a 2001 top, right? A 2007 or 8 top. You don't know if this is going to be a top, right? Only in hindsight we're going to know. But you can see, because of this, you see all these, that's what I was showing you, all these flags there, whatever you have along the way, right? Those moving averages, the distance from the longer term moving average, I'm going to put back where was I? My SPX chart. Here, I'll put, in this run up here, there was a whole bunch of daily chart pull flags, right? Because any uptrend, the basic components is pull, flag, right? And the flag usually, it resolves upwards in a bull market, and the flag usually fails at the top, and then after that you have bearish, right? Bearish flags. As you move up this ladder here on the longer time frame, each of these smaller term pull flags, these corrections on the daily chart, have less and less chance of resolving upwards. So right now the odds are that there's increased odds that this flag here, or whatever, this pull, this flag congestion area here, the odds of it resolving upwards right now are much less than they were here. They're much less than they were here, right? They're much, much less than they were down here, right? It's just because you're stretched on a hard time frame, that long-term buying power is just evaporates over time, right? It needs a reset, right? It needs a so this right now, people when they just look at one time frame, they make the mistake of not looking at the hard time frame, and they say, okay, well, it's going to resolve upwards. Well, hold on, you don't know where we're going to be. It could be here at the 2000. You could be here. You could be at the top like you were back in the 2000s, right? If I go here to 2000s, you know what I'm going to do for you? I'm going to put here. I'm going to put what's 365 times 3? It's going to be 1,000 about. Here, I'll put the distance from the 3-year moving average about here. So you see all these pull flags we had here in that 1995 run. As long as you're coiled and tight closer to the long-term moving average, you have a higher chance of success, right? But as soon as you get really stretched and you're starting to lose, doesn't mean the price can't go up anymore, but you're starting to lose upwards momentum. And then after that, when you start to really lose an important top here, look at that here, bam, you fall. So right where we are today, we're up here. So as long as this, the longer term rising trend line does not fail, you're good, but the higher up you are that ladder, the less probabilities are that it will continue upwards, right? It's just not the low risk entry. You could look at Microsoft, you could look at NVIDIA. Oh goodness, NVIDIA, my goodness, look at that. That is one chart look at that. This at the bottom is the distance from its 3-year moving average. Look at this. When you had these important toppings, top here, look how stretched it is. I'll put a horizontal line for your viewing pleasure. Look, up, you don't know how long. It could keep going up after it starts talking. But once it starts rolling over, I'll put some vertical lines for... there's not much left. Like even sometimes people, oh, Patrick, it kept going up. Yeah, sure. I don't mind if it keeps going up. I didn't lose any money because it kept going up, right? I'll lose money if I hang on while that thing's going down. But you tell me when you see that visually, where are the lowest entries? It's like low risk entries are coiled and tight, exploding upwards. Coiled and tight, exploding upwards. This one, look at that. The momentum, often the momentum will fail. So the momentum, I define it as distance from a moving average. The momentum will fail before the price fails because you're losing. You're on the highway, you're running out of gas, you can't accelerate as fast, you're redlining. And oh man, look at that. I'm going to put on the line chart just to make sure. So it's losing, rising. Like, the more steep an angle trend line is, there's still energy going upwards, right? So you got to wait. Eventually, there could be a trend line here. Eventually, there'll be maybe a flat one. The flat ones, of course, are the more important trend lines. But it's just crazy, man. We're just not at a low risk entry. And even from a classical TA, you have a whole bunch of measured moves. I also do that exercise. I always look, okay, well, let's see. Sure, distance, but look, pull flag, measured move, reach, target reach. Like, what are you expecting here? You're expecting rocket ships nonstop. Eventually, you need another flag to build out, right? You need more momentum to reset. Once these targets are reached, that's it, right? It's like this is just nonsense right now. This is a time to US dollar or whatever. The US dollar is doing great. I was linked to you guys, and I just wanted to share something. If you want to know, for me, what drives more, let's say the US dollar. So here, guys, this one here is the CAD USD, and this here is the Canadian rates minus the Fed fund rates. But you could do this, because I did this really fast there while listening to you guys. You could do the US 10-year yields or the Canadian 10-year yields minus the US 10-year yields, any yields on the curve. It doesn't track perfectly, but for me, what drives a currency pair more is the delta. Is there more incentive for somebody to hold Canadian dollars or US dollars? And primarily, if I would ask just anybody, well, I'm going to look at the interest rates that they pay in the bank, right? So I don't know look at that, look at the delta. So as long, it's not that the US rates could go up or down, it's how much more or less are they paying you than what Canada's paying you. I did it also for Japan real fast. Here's Japan. Okay, here, this is the yen. This is the Japanese USD pair. I know usually we see the inverse, and this is the Japanese rates minus the Fed fund rates. It's not perfect. It's like, that means there's probably something, there's more stuff interfering in it. But look, as long as it's trending in the same direction, you gotta anticipate, unless maybe this was the bottom, it goes up. You have additional evidence that it's still more favorable to hold US dollars than the yen. So you gotta expect that the yen's going to keep, it's going to keep falling versus the US dollar. But again, whenever there's doubt, guys, I'm a chart trader. So that peripheral evidence is fun, but you don't trade the peripheral evidence. You trade the actual chart, right? So you got to look at the actual chart. Is it stretched from moving averages? Has it reached measured moves? You got to look at stuff like that, right? But the DXY is looking to go here. The DXY for me is like, it looks like it has a destiny of 120, right? Who would have thought? Look at that.
Yeah.
It's like that thing's heading to 120. And guess what we had at 120? That was the peak. That was the dot-com bubble peak. And there's often another peripheral evidence or weight of evidence. I overlaid here the SPX. I'll overlay also, let's say, recessions. Put recession indicator on top. The US dollar is like, I see it like a wrecking ball. And depending when it flares up, and if it flares up and the US equities are stretched and having a hard time, see here, the US dollar just going bonkers. Look at that. That was a dot-com bubble. Like just that melt up here out of this rising breakout line, very aggressive, the move downwards, right? So I'm wondering, I don't know, like, again, you can't trade these analog things, but makes you think that if the US dollar is going to run up here, if ever and whenever the SPX actually does lose a rising trend line, that's probably when the US dollar is going to start to unwind, right? They're going to drop rates more than the Eurozone, more than Japan, probably to save the US equities, save the labor market, whatever reason they're going to do. And it's going to help put a floor under the markets. But look, it's crazy, man. There's so many moving parts in all of this. You gotta, if ever, like for a newbie or anybody who's like, okay, this is too much stuff, then go back to the basics, look at the chart, pop up distance from the 36-month moving average. If it looks like that, just don't. Who cares what Michael Saylor says, or who, like, you just step aside, you wait, and you wait until, like, it's, we have like when you play poker, you're, of course there's blinds and sometimes there's antes, but you could wait for your hand. And as
Yeah.
a trader, you could wait for that your hand also. You don't need to, to always have your hand in the cookie jar, always playing every single pot. You could wait. And the more charts you look at, the easier it is to wait, because let's say Nvidia is not ready, and well, there's other sectors, right? When the tech stocks are topping and going down, what's happening? Well, there's energy, right? Let's say I put range resources there. Look at that. Range resources, like distance from moving average. Do you buy here? No. Even here, even if the price went up here, buying here is not a low risk proposition. But look now, coiled and tight, close to the 3-year moving average. As soon as the momentum maybe starts breaking out of more important, less slanted rising trend lines, then you got fuel, right? The distance here in moving average, the explosiveness, the reservoir of explosiveness before FOMO catches on, before your hairdresser tells you that he made a bunch of money in oil plays. Well, it's happening here, and that's kind of like, kind of a, look at that, a false breakdown, a bearish rising wedge, false breakdown through the apex move. If that thing closes above that black line, it's going to be a crazy move out of this thing, crazy, and especially because of the setup. So people don't like oil. I know there's a recession, like all that risk, but sometimes you often seen oil flare up in the first half of a recession, and then, like, when everybody says,
It
okay,
creates a recession.
yes, exactly. It's like the
higher prices
last,
that does it.
here, I think I have it here, there. I did it for, okay, I have to go on the smaller time frames there, but if you overlay the recession chart and oil, okay, not the 2008 one, but look at that here. Look at that. Oh, yes, the 2008 one. Look at that. Huge flare up during the recession. Huge. It's like, and I think even 2001 did not do it. Flared up a little bit before, but you see it bottomed not at the beginning of a recession, right? Like much later.
Yeah. Well, Patrick, I have to cut us off there just because I have to host the Morning Edge show. But let traders know best way to follow your work.
Sure. Bad Charts One on X or Twitter, and I have a paid membership website with my friend Kevin Wadsworth, NorthstarBadCharts.com. You could get all these in-depth review and analysis there on that website.
All right, Patrick. Well, thanks for joining us. Happy Friday, and thanks for joining us on this non-farm payroll day.
Thank you, sir. Take care.
All right, and guys and gals, like I said, we'll be full. Well, actually, Dale will be back on Monday, and he'll be happy to be back, I'm sure. And K-Man will be back on the Flow Show, and we'll have a full team here next week. So, good luck. Thanks for hanging out with me today, and happy Friday to everybody. All right, bye bye.